All right, so we're going to try to stick to time, and I'm just going to go ahead and get started, and hopefully folks will continue to trickle in. I know I had some really great conversations with folks at lunch today, and it sounds like others did too from the sounds of things. So I hate to cut those off, but do encourage you to consider those after our final presentations today and in the future, as I'm sure you will. So this afternoon, I'm very happy to be introducing Dr. George Mokrzan. He will give us an economic outlook, and he's Director of Economics for Huntington National Bank, which is headquartered here in Columbus. He conducts economic forecasting and analysis, and previously led the Economic Advisory Committee of the American Bankers Association, conducting economic forecasting and engaging with policymakers. And he serves as an authority on employment, manufacturing, and international trade and their impacts on the Midwest. So we're really pleased to have him on our program here today, and welcome, George.
Thank you very much. It's really an honor to be here in this great institution, this great department, and everything so positive that you do in the advancement of knowledge. I'm going to get, I have a lot of things I would like to talk to you about today, and so I'm going to get right into the meat of it. This is the general economic forecast for the next year, and you'll find that it basically is pretty benign in terms of what's been happening. Continued economic growth at a modest pace, 2.2%, inflation around 2%, interest rates gradually rising. But I think that this all masks a lot of dynamism, a lot going on underneath the economy, if you will, especially at the sector level. And that's what I want to talk quite a bit about today. In particular, we're starting to see a slowdown in the consumer. Consumer spending slowing, and obviously consumer spending is very important for the U.S. economy. But in turn, what we're starting to see in 2017 is a reemergence, if you will, of the goods side of the economy, whether it's manufacturing, commodities, international part of the economy, exports, even commodity prices. And we'll talk a little bit more about that because that's an area that obviously this group is especially interested in. And of course, we have, even though the overall forecast is rather, again, benign, if you will, there's a lot of forecast risk based on the policy side, and we know that. There's a lot going on in Washington in terms of tax policy and other policies, and that could have a big impact on the economy in the next year. In general, this chart shows that the economy is doing quite well. This is the ISM. Anything above 50 is economic growth here. You can see that that's kind of continued at a pretty nice pace here, and it's actually picked up in 2017, especially in the last month. And that last month is a function of the hurricanes. The hurricanes actually, the rebuilding after the hurricanes actually is stimulating economic activity, probably temporary, but again, that adds to that good side of the economy, that rebound, if you will, on the good side of the economy that we're going to talk about. This is the new orders part of the ISM index, and that also is generally above 50. It's broken out between manufacturing in blue and non-manufacturing red. Agriculture is, of course, in the non-manufacturing part. And that also is showing very strong growth here in 2017. So another general positive. This is looking at sectors of the economy, businesses, asking businesses how things are going. And they're saying orders are growing. Take a look at the unemployment claims. And I think this is a very good indicator in general of if the economic expansion is going to continue. Because typically it's very sensitive. You can see that prior to the recessions, which are marked in gray, they typically start picking up. And we've had a very long sustained period of unemployment rates declining. Those unemployment rates spiked again during the hurricane period. The Houston economy, just on its own in that MSA, is about the size of Michigan's in terms of GDP. So that was a huge hit, a temporary hit to economic activity. But those workers, even though many were let go, as many as 100,000 range in just the restaurant areas alone, Many of those people are coming back to work now, and the unemployment claims have come back down, and we're resuming that downward trend. So again, this is a positive for the economic expansion. I like to show this because typically we just got off a Friday where everyone's looking at the employment report and trying to interpret whether it's 200,000 gain or 180,000 or even 100,000. And the point of this chart is that payrolls are growing, employment is growing at a sustained solid rate. Millions of jobs are being created in the economy. They have been created in the economy, and they probably will continue to be created in the economy. So I think growth is something that we in general can depend on. Another way of looking at the economy is looking at the unemployment rate. Official unemployment rate now is at 4.1%. That is now the lowest in 17 years. So again, that's an indication that labor markets are firming. Look at this. This is the underemployment rate, which is a broader measure that includes people working part-time that would like to have full-time jobs, people that are marginally attached to the workforce. And this is an indicator that's been a big focus in recent years, especially by the Federal Reserve in terms of monetary policy. You can see how high it spiked to 17% right after the recession. That has now come down to 7.9%. This is the lowest to December of 2006, which was a year before the Great Recession began. So again, this is another indication that the labor market, job markets are improving. Now, a lot is made of those low unemployment rates and the view that there's no workers left to hire. And I think that this chart probably disagrees with that, or at least it makes me disagree with it. This is the labor force participation rate of some important segments in the population. We have the 20 to 24-year-olds in blue. This is non-seasonally adjusted, so there's a little bit of vibration there. The 25 to 54 in red, and the 55 to 64-year-old in black. And what we see is that the participations are starting to pick up a bit. And again, that's in response to improvements in the labor markets, improvements in the economy. And the question is, are there enough workers left for the demand that's coming online? And I think one has to keep in context that we're talking about huge numbers of people here. So for example, in that 25 to 54-year-old group, there's over 100 million people in the United States, Americans in that group. So even a 1 percentage point increase in participation is going to result in 1 million workers coming back to work. I think the most disturbing of these participation rates, of course, is for the 20 to 24-year-olds, which has really dropped off in the current decade. That's, I think, a national tragedy. We're starting to see that come back up. That's a smaller group than the older group. However, obviously, for the long term of the country, it's much more important in terms of all, for example, just 1 percentage point in the movement, and that rate is going to have a big impact long term on all aspects of the economy. So this is an area that needs, I think, more attention for policymakers. Taking a look at consumers, in general, this is the household financial obligations ratio. It's basically a debt service, how much debt people have to pay relative to their personal incomes, plus some additional items like auto lease payments, property taxes, insurance. So it's a fairly comprehensive kind of measure. And we can see that actual measure is the lowest since it's been since the early 1980s. So that indicates that consumers basically, in terms of their finances, are looking pretty good. And that, of course, is a positive here for economic growth going forward. Now, this chart shows the actual aggregate levels of debt. The green line is the household and nonprofit outstanding debt as a percentage of GDP. It's all over GDP. The non-financial business sector is in brown, and the US government debt, that's both federal and state and local, is in blue. And what the real positive here is you can see that the consumer has basically deleveraged, brought debt levels back down. A lot of that is because mortgage debt has been reduced in recent years. But still, that ratio is more healthy overall for the consumer. On the other hand, businesses have been living it up a little bit. You can see that the debt has been rising for businesses, and government debt also has returned to relatively high levels, although it has hovered around that 100% level for several years now. So it looks like it is stabilizing. All right, now this is a very difficult chart and I kind of deliberately put it up there. When we talk about inflation, we tend to think of inflation as being similar across sectors and industries. Nothing could be farther from the truth. The CPI is an average of many different areas of spending. And what we see in this chart, blue is the actual CPI on a year-over-year basis. What you see towards the top there in the black lines, that's the services. And services inflation has actually been running about 3%. And that's easing back a little bit recently. The goods side of the economy is towards the bottom, towards that zero line. And you can see that essentially goods, there's been actually deflation in goods. And energy has been is really so volatile, I couldn't even put it on this chart. But you can see where food stands here. And you see also food has been on the deflationary side relative to other prices. So this points out that when one has to be very cautious when looking at these aggregate measures of inflation, to look beneath the surface. Now, a measure that I prefer for inflation is actually the producer prices. This is the all prices in the economy, including all prices that go into forming GDP, both consumer and non-consumer. And you can see here that has actually dropped off quite a bit in 2015 and 2016, even for stripping out energy and food. But it's been coming back pretty strong here in the last year. So inflation at the producer level is starting to pick up. And I'll show one more chart. This gets a little technical, but this is the Fiber Industrial Materials Price Index. And I view this as kind of an indicator of future inflation. And if you look at the periods when this was rising strongly, during the 1970s, which was obviously a big inflation decade in the United States, and then it stabilized, was steady for a couple of decades, the low inflation from the 1980s and 90s until the last decade, and you see it's rising again quite strongly. We did have inflation before the last recession, and if we didn't have it in the actual measures, we had it in housing prices, which sometimes doesn't show up in the CPI because of the way the CPI is constructed. Since the recession, we had a surge of inflation early on. That's dropped off. We had almost a period of deflation here in the last couple of years. That corresponds to the slowdown in the world economy, slowdown in China, slowdown in Europe, slowdown in other areas, which had especially put downward pressure on the goods area of the economy. And now what we're seeing is some improvement in the international economy. With that improvement, that is also pushing prices up worldwide as well. And that upward trend again is largely a function of improvement of the overall world economy and the upward pressure it's putting on prices. Now this is a overall commodity price index year over year, very volatile, and I'm sure that you've seen multiple charts like this probably even during this conference. And I think that the important thing to keep in mind here is that every farm, as local as it is a function of world prices, world commodity prices, what's going on in the world economy. And also what's going on in terms of the recession. So you can see in both of these gray areas, which are recessions, big spikes in inflation in commodity prices prior to the recession, then a complete reversal, and then typically a nice bounce, a V-like bounce afterwards. And the percentage changes here are can be quite significant. So you see in the range of 30–40%, not uncommon. What's unusual is that at this point in the economic expansion that we've had such weak prices. And again, you can see that that dip again, close to 20% in regular commodity prices and also food stuffs as well. Now going forward, I think that into 2018, my forecast is that those commodity prices are going to rise above zero and be positive. So we'll do that in 2018. We'll have positive price growth in both commodities and in foods, and that'll largely be because of improvements in the overall world economy. We've seen Europe strengthen, we've seen China at least stabilize, and even Japan is improving, and many of the emerging growth type economies are doing quite well. They're gaining traction as well, probably because they're following the bigger economies of the world upwards. The major reason for the improvements, massive monetary policy stimulus across the globe, and especially in Europe. In Europe, some of the policies there are even more stimulatory than they are in the United States. All right, looking at just long-term interest rate trends, this is the 10-year Treasury, and you can see that basically goes with inflation. And so when inflation started moving up, that pushed up the long-term interest rates. When it came down, it brought long-term interest rates down. As long as inflation stays around 2%, we're likely to see long-term interest rates stay pretty close to where they are. But if we start seeing stronger inflation overall, most of those industries starting to show price increases, then we're likely to see increases in the long-term rate. And I would expect increases in the long-term interest rate, maybe not large ones, but some increases in 2018. Just some historical kind of context in terms of the current economic recovery basically is a modest one. We've got economic growth at 2.2% on average. That's well below the numbers in the previous economic cycles. The problem with slow growth is it makes the economy more vulnerable to shocks of any sort, no matter where they're coming from. It also makes it vulnerable to forces like higher interest rates and inflation. So that is a bit of a vulnerability to the economy. Another kind of very topsy-turvy kind of statistic has been personal incomes and the ability of the economy to generate it on a sustained basis during this economic recovery. Now, there's been a lot of fiscal policy uncertainty, fiscal policy changes. There's been recently the world recession, if you will, or at least slowdown in China and Europe in the last couple of years. So that's had an impact here. Certainly has had an impact on farmers. But that is a bit of an issue also in terms of the strength, the sustainability of the economic recovery. This chart it demonstrates maybe the money illusion. We go back to 2000 and we look at personal income, just as it's given out, as in dotted by companies and businesses and farms and individuals, and that's the dotted line. And then we control for taxes, and that shifts it up to the red line. That's primarily because of the tax cuts in 2001 and 2003, the federal tax cuts, and then subsequently those were made, many of those were made permanent. So that's kind of rotated that line up a bit. But then we control for inflation, and that actually rotates that line all the way back down to the blue. So even though incomes have grown tremendously in a nominal sense since 2000, you can take more than half of that away just because of inflation, even though inflation technically has only been rising at about a 2% rate, at a slow rate. And then to get an even more precise handle on what's going on with incomes, we take it on a per capita basis, which takes it down to the black line. And essentially what that black line shows is that in the last few years, real per capita disposable income is basically stalled. It has not been growing. So that is another negative, if you will, for the US economy. All right, unfortunately, I think a lot of, virtually everyone here knows this story. This is data just only through 2015. It's not updated. I'm going to show you an updated one in a second. But obviously, farmers have been struggling. Their incomes have been struggling. When we take a percentage on a year-over-year basis, the chart looks something like this. So you see the big up and down before the recession, the big sharp decline after the recession, the surge, then the V-like recovery in agricultural prices, as it was in many goods areas of the economy. Maybe not the overall economy, but in these prices certainly is recovery. Then a bit of a flattening over a few years, and this big drop in 2015-16. A lot of that is the slowdown in China. Again, the slowdown in the world economy, a lot of it in Europe, and transmitted to other emerging economies as well. But the positive thing is this year, these prices are starting to rise. So we're starting to move out of that zone, and at least forecasting that this time next year that it's going to remain in that positive territory. A number of different charts here showing which way the different aspects of the economy, and I think the one similarity you're going to see is this big dip in 2015 and 2016. The economy, parts of the economy went into recession. Maybe not the whole economy, but the good side of the economy were definitely showed significant decreases in 2015 and 2016. This shows manufacturing, wholesale trade, even retail trade slowed during that period. We're getting a re-acceleration in 2017, and I'm forecasting that this improvement is going to continue into 2018. Again, a similar kind of pattern here. This is capital goods, new orders. You can see the very high sensitivity around the recession, the V-like recovery, very strong growth first couple of years, then a flattening, then again a mini recession in business equipment. Part of that was energy, because the energy sector had really taken a very hard hit, and they recently have normalized with energy prices. But it also is a function of improvement in the world economy. And again, this is another area that I would expect to continue to show positive growth in the next year. And exports. Exports obviously a critical area for the agricultural sector. Again, you see the same kind of pattern, very strong in the early years of recovery, flattening, then essentially a recession in 2015 and 2016 in the exports. With the resurgence of the world economy again, late 2016, 2017, we're back in positive growth territory again. And just to close out on exports, this chart shows how export volume since 2003 in the US, which is in red, and compares that to other major countries and the total advanced economy, which is the black line. And you can see the United States is actually doing very well in terms of expanding exports. The US is an export power, and it obviously has further potential, and that it will continue to be an engine of economic growth in the years going forward. You can see that the world economy, which is in green, is actually underneath the United States. So US has even done better than the world average. And a lot of that is because emerging market economies are picking up exports at a very quick rate, still doing extremely well relative to that standard. This indicator is a summary of what's going on in the world economy. It shows a summary of economic statistics and sentiment for the world economy, and you can see that they had dropped off in 2015, started rising in 2016, and now is at its highest level since May 2006. So another confirmation that the world economy is improving, and with that, we should see improved prices, rising prices in the case of agriculture, and also in other areas of exports. And this chart also shows the export prices, again, very volatile, but you can see that they generally move with other prices that are part of exports, which are in blue, but just much more dramatically. The very high sensitivity to economic disturbances, and that probably will continue. But by the same token, if we get improvements next year, that we could also see some positive surprises as well. Okay, I'm going to turn now to talking about the local, the regional economy, which I know there's a strong interest here. This actually looks at Ohio, which is in blue, and other states in the United States, and how much they've grown on a percentage basis since the essentially the end of the recession, which is June of 2009. It's an indicator. It's basically a proxy for GDP. GDP growth is produced by the Federal Reserve Bank of Philadelphia. And if you track that dotted line, you can see that the U.S. grew about 25% in activity since the end of the recession. In contrast, Ohio's grown closer to 30% since the end of the recession. So we've grown faster than the nation, but we're in pretty good company. A lot of these states are Midwestern kind of states, have similar kind of economic structure, balance, both agriculture and manufacturing, as well as services. So these are very diversified types of economies generally. The only states that kind of underperformed are Pennsylvania somewhat and West Virginia. West Virginia was because of the decline in coal prices. Midwest consumer confidence has been going through the roof. That's in red. And you can see that we also have the National Consumer Confidence Index going up there as well. Consumer confidence, the highest in 17 years. And again, this is Ohio, Michigan, Indiana, Illinois, and Wisconsin. That's the grouping that this particular data comes from. I think what's interesting is that if you look back in the last decade, the Midwest was more depressed than the nation. And at that time, we had some challenges. We had challenges in trade. But at this point, the economy is picking up, it's improving, and exports have been growing. So the economy essentially is functioning differently since the recession than it did prior. Take a look at unemployment rates, and you can see that again, these unemployment rates are extremely low, as low as 3.5% for Wisconsin. And the dramatic thing is that how much they've dropped during this, during the economic expansion, especially for Michigan. As you recall, Michigan was essentially left for dead by just about everybody. And their unemployment rate actually rose in the last month, but it was below 4% this summer. So tremendous performance. Ohio actually kind of was doing extremely well up until September, October of 2015, and it's slowed down a little bit in terms of making progress on the unemployment rate since then. This is the employment growth rates for different states, again, during the economic recovery. You can see the dotted line is the United States. The employment grew about 12%. And during that same time, Ohio did quite well, kept with the U.S. up until a couple of years ago, and it started slowing down a little bit. But still, we're still showing employment growth. And you can see that the states that are doing the best, we're starting in the middle of the pack. The states that are doing best in terms of creating new jobs are Indiana and Michigan. Okay, getting a little more local into the Ohio scene, this is the large metropolitan areas and their employment growth on a percentage basis since 2000. And first of all, the dark black line is the U.S. So the U.S. has put on 12% increase in employment, payrolls, this millennium. In comparison, Columbus, for anyone that's from Columbus, we'd be happy to note that it's grown 18% during that same period, so well outpacing the nation in terms of employment growth and having a really spectacular economic recovery. So you can see the slope of that line is actually steepened. The red line, Cincinnati, also doing relatively well during this expansion. It lost a little bit of ground last decade, but also showing some very strong employment growth in the southern part of the state. Unfortunately, the northern part of the state is not doing as well. So the brown line is the Cleveland MSA, and they've actually lost 6% of their payrolls since the new millennium. And as a result, the average for Ohio is just about a parity, almost a parity during the new millennium. So there's a wide divergence of employment growth in the U.S. In the Ohio economy. This chart shows that essentially Ohio economy, the GDP is in this green color, and it splits it out between private services and private goods. And essentially private goods is still the big area in the Ohio economy. Obviously there's a lot of manufacturing there. Agriculture is of course in there as well, construction. Ohio remains a goods producing kind of state, and that's where a lot of the strongest growth has been, even though the service sector still is quite large in the Ohio economy. And just to kind of close on some of these points, I want to open up for some questions. This is export performance of Ohio since actually in aggregate. And we can see that it's kind of leveled off, unfortunately, and not making as strong an upward move in the last year as some of the other states. So that might be something to take a deeper look at. And finally, to close on a forecast, this is the leading indicator for the Philadelphia Federal Reserve Bank, and that's showing by the dark colors relatively strong growth in Ohio here in the next 6 months. So that kind of concludes my discussion, but I'm certainly open to the questions. Yes.
Every president since Ronald Reagan has essentially doubled the federal debt. How long can we go on doing this? And is Trump offering?
You know, the issue is debt relative to GDP. You know, one has to look at policies as how they impact both the numerator and the denominator of that ratio. And I think that's the challenge for policymakers right now. Debt is rising, but to the extent that GDP can rise at a strong pace as well, or even at a faster pace, then that ratio could even come down in the intermediate to longer term. So there are a lot of factors that feed into that. It's not just the absolute level of debt, but it's the policies in the economy and what kind of economic growth is going on in the economy. Yes, sir.
Two questions related. One is the probable appointment of the new chair of the Fed. And how do you think that's going to affect monetary policy? But secondly, we're still pretty close to the lower band. How much wiggle room, whoever's in charge of the Fed is going to have, if we have a particularly, we have another strong shock, negative shock to the US economy?
Okay, great questions. The Chairman Powell is actually, he's been on the board. He's been a part of a lot of the policy decisions in the last few years. I would imagine to be quite close to what policy has been going on here in recent years. So not a whole lot of change there. In terms of the lower bound, the Federal Reserve is trying to raise the Fed funds rate any opportunity it has in order to give itself wiggle room to reduce that rate if the time comes. There is a reduced amount of leverage to do that. But on the other hand, the policy still is highly stimulatory as it stands right now. Interest rates are extremely low. They're really inflationary. They're so low. If we start getting some of these movements in next year in the international economy. So if the economy gets a hard shock, I think the Federal Reserve would probably reduce its rate. It argues that it can do more QE. It probably could, but I think that the onus would be more on fiscal policy than another shock. Yes, sir.
When you're charged 4.1% unemployed, what percent of that, no matter how good things get, will never go back to work?
All right, well, nobody really knows that for sure. And there certainly is a structural unemployment in the U.S. economy, and it's been increased. The longer there is a high level of unemployment rate, more people basically slide into atrophy in terms of their skills. So that is not known. However, again, we're starting to see improvements in that. And as soon as wages start rising, that's going to raise incentives for at least those people who still have skills to come back into the labor force. And I think that'll be a lot. That's going to be, I think, a topic next year. If wages rise, which they should now, given the level of unemployment rate, there's some stronger wage growth. What will be the sensitivity of this participation rate? How many people are going to be coming in? And I think we're going to find out. We're going to find out much better. We're going to have a better answer for that in the coming months. That's right.
Following a bit on that point, you hear a lot of stories about employers not being able to find employees, and a significant part of the problem seems to be failure of drug tests. I've never seen anybody talk about employable people. How big a pool is that, given this particular kind of problem? And then secondly, I don't believe that you showed anything about wages, discussion about why wages have not managed to turn upward in spite of the low unemployment.
Yeah. To answer the second question, the wages are kind of wrapped into the personal income story. So if wages are only rising 2.5% and inflation is 2.5%, real disposable personal income is flat. So that's kind of implicit in that discussion. So that's part of the challenge there. That's going to have to change. That those real wages have to grow. The drug problem, that may be something that experts beyond me will have to deal with that. I've heard those anecdotally, those discussions as well from different, because I travel around our region. It's a tragedy, but I do think that the opportunities have to be made. And if the opportunities are strong, I think that the incentives for, deteriorating in those kind of situations would probably, the risk of that would reduce some of as well. So maybe the focus needs to be, yes, there are problems, but what can policy do? What can the economy do? What can private companies do to start bringing more people back in? Yes, sir.
Well, in light of the previous good question, what is the implication of that? What was it, 25 to 34 age group at such low inclusion rates in employment?
Yeah, I think it's a very good question, and I kind of ask it myself by including that in the chart. I think a better job could be done, in all likelihood, in bringing more people into the workforce.
questions, thank you so much.
Thank you. Thank you very much.